morning, ladies and gentlemen, and welcome to the Sefalana Group results for the year ended 30th April 2020. 2020 has been an unprecedented time for us and those around the world, and in the spirit of social distancing, we felt it appropriate not to host our results presentation at a hotel or conference, but this time to do it in the form of a pre-recorded video. You, along with a restricted number of guests, will be invited to view this video and will be given a link thereafter for a quick Q&A session where you'll be able to ask any questions to clarify anything that we presented. We hope you find this method of delivery useful, and the pandemic has come with its own silver linings and forced us all into thinking of doing things better and in different ways. Welcome once again to our presentation. Last year, we presented to you our best ever results in our 46-year history. This year, we're proud to say we've done it once again. This year's results are virtually in line with last year, but this is despite difficult trading conditions in the region and the onset of the corona pandemic. These are, therefore, fantastic results, and we are very proud of them, and we hope our shareholders and potential investors share in this enthusiasm that we have at Sefalana. I will now hand over to Mr. Chandra Chauhan, our Group Managing Director, for the first part of the presentation.
Good morning, ladies and gentlemen, and welcome to the results presentation for the Sefalana Group for the year ended 30th April 2020. In terms of headline numbers, we opened 9 new stores throughout the region. Our revenue increased by 10%. Our gross profit increased by 14%. Profit before interest, tax and amortization increased by 7%. Profit before tax was flat at 259 million pula. We have declared a final dividend of 27.5 tebe in line with last year's final dividend declared. So overall, a great set of results. There were some key factors that impacted this year's results. These all had a significant negative impact on our reported numbers. Foreign exchange volatility has been very significant in the region, with the South African rand being impacted on a daily basis. Given our reliance on the South African currency and the fact that the pula is pegged to the South African rand to a large extent, this negative volatility resulted in significant forex retranslation losses. In other comprehensive income, you will note 86 million pula being recorded as the losses relating to the retranslation of foreign denominated investments, in particular Metro Namibia, Sefalana Lesotho, and the South African preference share investment, which are all South African rand denominated. They are, however, by their nature, temporary and unrealized losses, which will reverse as the South African rand normalizes. Another key factor related to the first time is adoption of IFRS 16 on leases. This is a new accounting standard and has impacted all industries. This new standard now requires companies to record leases that previously were treated as operating leases as finance leases. This resulted in a large right-to-use asset and corresponding liability on the balance sheet. This will unwind over time, and the unwinding that took place in the income statement for the year resulted in an additional charge of 4.7 million over and above what would have been under the previous standard. The group profit before tax would therefore not been 259 million, but rather 264 million pula, or 2% higher had it not been for this new standard. The third factor is the COVID-19 pandemic, which has impacted the entire world. This resulted in a shift in buying behavior and a change to the way we did business over the lockdown period and beyond. Although we are considered an essential services business, trading levels dropped significantly as a result of restrictions placed on movement of consumers. We are pleased to have been able to assist the government with its relief program through donations and partnering with other large organizations. So before getting into the detail of each area of our business, we thought it would be useful to outline the main pillars that impacted the group results for the year. Firstly, as mentioned previously, there was significant forex volatility, in particular with the South African rand. This mainly impacted our FMCG business, as the bulk of what we buy is from South Africa. Volatility in terms of commodity prices also impacted mainly our manufacturing businesses. The price for maize, for instance, was very unpredictable, and towards March and April, there was a significant shortage of maize because of the impending harvests in the region. Given the high levels of competition reported previously, margin focus and product mix changes were necessary. Some of this was deliberate to improve margins, but some of this was as a result of changes in buying behavior. Our overhead cost reduction continued throughout the group with the target 10 million savings that we set out to achieve. Government spending has been significantly lower than in previous years on tender and feeding schemes. This time it has taken for awards to be made for a longer period than the past. However, there were significant delays in the award of these tenders. At our manufacturing sites, we have focused mainly on branded products to mitigate against this dependence on government. At the center of all this, in the second half of the financial year, was the onset of the COVID-19 pandemic. This impacted all our businesses in different ways and impacted the country and the world's consumer confidence and buying behavior. We have now spoken about the key pillars, but what were the main market themes we experienced? The financial year can be seen as a year with two distinct halves. In the first half of the year, as indicated at previous presentations, we were beginning to see signs of recovery in the Botswana market after a period of difficulty. We were optimistic about these changes and were looking to improve times. In Namibia and Lesotho, however, signs of strains were beginning to set in and we were anticipating some tough times ahead. Customers were beginning to become more sophisticated in their buying patterns. Luxury spending, more frequent visits to the stores began to set in. The vibe began to improve. Less so in Namibia and Lesotho, but very much so in Botswana. Margins in Botswana began to improve. The second half of the year was not so positive. The early signs of COVID-19 began to set in. Restricted trading hours, lockdown, fear of infection all set in and resulted in a more cautious consumer. Uncertainty resulted in world economies taking strain, and in particular relevance to us, South Africa began to feel the deep impact of economic strain. The South African rand depreciated against the Botswana pula by over 10% in a very short period of time. Government focus was on addressing the pandemic, and there were delays in the award of food tenders, in particular Tsabana and Malutu. Whilst all this was happening, the group took the decision to maintain jobs wherever possible and to continue to pay all our staff in full at businesses that were not considered essential services. We have done well as a group to navigate through this difficult time and have put in a number of measures to ensure we are working smarter and more effectively to overcome these challenges. How did we do this? We had a number of macro level responses. We focused on maximizing returns from our Botswana businesses where we were seeing positive signals. We embarked on better and smarter procurement, basket and mix focus, and listening to what the consumers wanted to help improve our gross margins. We had significant expansion in both Lesotho, where we opened 2 stores, and in Namibia, where we opened 7 new stores and closed 1 store, old store. We continue to evaluate alternative markets for investment, taking into account our exposure to the South African rand and the region. Given the reduced spending and delays in awards of government tenders, we focused more on private sector and branded product ranges. This helped reduce dependence on tender activity and helped us generate the required levels of profitability. We will now look at each of the headline results in turn. Turnover at 5.8 billion was 10% up year on year, and as can be seen in the chart, a strong upward trend over the last 5 years. The blue segment is the first half of the year and the yellow segment is the second half. Both the first half and the second half saw an improvement year on year. Gross profit of 387 million was up 14% year on year, despite the difficulties experienced. As mentioned before, specific focus on gross profit enhancement has been underway and is showing successful outcomes. Earnings before interest, tax and amortization of 237 million pula was up 7%, which was an excellent achievement given the challenges. We will look at EBITDA by segment in later slides. Profit before tax of 259 million was in line with prior year and would have been 2% up on last year had it not been for the adoption of IFRS 16 on leases as previously discussed. A review of the segments by revenue and EBITDA is now presented. Trading consumer goods, which is effectively the FMCG business in Botswana, both wholesale and retail, grew top line by 13% and EBITDA by 10%. Trading others, which is the motor division, commercial motors and mechanized farming, declined 4% by revenue and 27% by EBITDA. This is largely as a result of drop in government tender activity and a more cautious consumer during the pandemic. The previous year also had some once-off transactions. Manufacturing. That's the Serowe and Gaborone sites, which when combined had a 2% drop in turnover, but an impressive 83% increase in EBITDA. This was largely driven by a sterling performance by our beverages division that was awarded the 24-month government milk feeding program and the deliberate focus on growing the market share of the branded products. The property division did well with a 13% improvement in revenue and a 30% improvement in EBITDA. Part of this was a result of some revaluation gains experienced in Zambia due to the strengthening of the US-based rental streams. Namibia performed satisfactorily with a 5% increase in revenue and a 2% increase in EBITDA. These are after translations into pula. The Namibian dollar percentage increases are therefore higher. On the South African segment, there was 11 million fair value gain in the prior year on the preference share conversion option. For the current year, the value of the preference share has remained unchanged. Overall, therefore, revenue for the group was up 10% and EBITDA by 7%. From a PBT perspective, performance was flat across the group, mainly due to the large part of the lease cost now being recorded as a finance charge following the adoption of IFRS 16. Looking at the EBITDA wheel, we can see that our strategy for diversification has worked well for us. Diversification across sectors and across territories has helped us achieve year-on-year growth. Our focus will remain on the FMCG and related businesses. We also have built up a strong property portfolio that helps generate a strong performance. We continue to focus on identifying profitable sites. In terms of territories, we have some exciting developments which we'll discuss later in this presentation. Let's now take each business segment in turn. We will now start with FMCG sectors in each country. Trading consumer goods segment. This relates to the cash and carry and retail business in Botswana, which contributed 57% to turnover and 26% to PBT. We opened 3 new stores in the year: Shopper Kazungula, Sefalana Quick Setloa, and our flagship store, Shopper Setloa. We took a cautious approach and slowed down expansion. At our flagship store, we are focused on enhancing our offerings through one of the country's best butchery, bakery, and hot food counter. We also have an in-store pharmacy. We have really listened to our customers and tried to offer them what they want. During the lockdown, we offered our customers a WhatsApp and email service that proved very popular. In this way, we were able to deliver and offer prepare and collect services to help our consumers during the challenging times. We also rolled out our first ever petrol station site at Setloa under the Puma franchise. We have plans to roll these out throughout the country as and when sites become available. Now turning to retail, our Sefalana Shopper brand continued to grow from strength to strength, and its brand awareness is now building momentum. We just celebrated 10 years of retail this year. We now have 29 stores across the country. We are moving into better locations and more prime sites. We look to grow this division and increase the market share in the ensuing years. Partnering with other service providers will help us provide additional offerings to our customer base. Our in-store pharmacy at Setloa, for example, has proved to be very popular, and we look to replicate this model elsewhere as part of the growth strategy. We have also improved our in-store offerings, in particular our fruit and veg business that is now fully managed in-house and no longer part of the joint venture. This has now become more profitable too. Throughout the year, pressure on margins continues. However, an improvement in margin mix has allowed us to increase market share. Our A-Star house brand continues to do well for us in Botswana, with some additional product lines expected to be introduced in the ensuing year. In terms of annual birthday promotions, our wholesale business gave away 2 million pula worth of mobile kiosks to winners across the country. This was the second year we did this, and this helped a number of entrepreneurs set up their livelihood. Our retail business gave away 1.8 million in cash prizes, as we found our retail customer valued cash or prizes easily converted to cash more appealing. We are due to do a similar promotion this coming year on both wholesale and retail side, with prizes amounting to around 4 million again. During the year, an example of partnering efforts, we teamed up with FNB to offer a cash withdrawal service at our tills to all FNB card users. This has proved popular for those who do not have time to wait at ATMs or to visit their local banks. This is done in many other parts of the world, and we felt it important that we offer this too in our stores. Our loyalty program continues to be popular with our customers. At our new Setloa store, for example, we have a participation rate of over 50%. We look to achieve this sort of participation across all our stores. We are currently the only Botswana-based FMCG player in the country to have its own loyalty card. If you look at the map of Botswana, you can see that we have an impressive footprint across the country. We are present in all major cities and towns, and also in some smaller areas. We continue to expand this footprint as we increase our store complement beyond the current 62. Our catering business was launched early on in the year and is located in the old Gaborone industrial area. The focus of this business is the delivery of high quality, fresh, frozen foods along with catering equipment to mainly the hospitality sector. We have introduced over 2,000 new product lines that previously were not available in our stores, and we use temperature-controlled vehicles to deliver these products. As we said previously, the focus is mainly on hospitality, lodges, restaurants, and other catering institutions. The aim was to be the preferred supplier of choice for food services in Botswana. Unfortunately, as you can imagine, this business was heavily impacted by COVID-19, so the progress of this division has been slowed down significantly. As you are aware, lodges, campsites, restaurants, hotels were all closed during the COVID-19 restriction period, and we are optimistic, however, that once this hospitality sector recovers, the business will become a significant player in the industry. We now move our attention to Namibia. This business is in its 6th year of operation, and this has been a very profitable business for the group. We have generated over 250 million pula in profits in the first 5 years. Metro is now a very well established household name in Namibia, and the refreshed branding done a few years ago has helped consolidate this. This business contributed to 29% to revenue and 21% to group profits. In Namibian dollar terms, this business is still showing good growth. In pula terms, however, as a result of the adverse foreign exchange rate movement, the return was slightly reduced. We previously reported to you that the Namibian economy was taking considerable strain. However, due to decisions and capital commitments made in previous years, we did open 4 new stores and refurbish 3 stores. In the current financial year, we do not expect to open any new store. However, we do continue to look for additional sites in the Namibian market. We have placed emphasis on the importance of technology and have aligned the point of sale software to the same one used in Botswana. This is resulting in more accurate and better information reporting and therefore has helped enhance decision making. We recently introduced the provision of delivery and telesales to our customers, and this is proving to be very popular. We also launched the new customer care program in 2020 to our valued customers. Similar to our presence in Botswana, we now have an excellent footprint across Namibia. We started in Katima Mulilo and have now met out short-term target of 20 stores. Now turning to our Lesotho business, which has just completed its 4th year of trading. The Lesotho economy has experienced some strain, and this has placed pressure of the average consumer. Competition in the area has always been strong, largely from smaller traders who previously were able to bring stock from across the border. During the pandemic, this was not possible, and as a result, we found the level playing field in competition being re-established and performance of our business in the country improved significantly. 2 new stores were opened in Maputswe, a cash and carry and a liquor outlet. This has helped improve overall results, resulting in a 9% top-line growth and an EBITDA of 11% in comparison to 6.2 million in the previous year. Due to the size of the country, our presence is strategically placed around the capital Maseru and the large populated area of Maputswe. We do not have any current plans to grow our presence any further in Lesotho. We will now turn our attention to trading other. This comprises mainly of commercial motors and mechanized farming. This remains to be a very small segment for the group, with a 2% contribution to turnover and 4% to group profit before tax. The business used to be very reliant on government tenders and BDF contracts. As tender activity reduced over the years, emphasis has moved towards private consumer sales. Good progress was being made. However, the pandemic has resulted in a more conservative consumer who appears to be deferring purchases of large capital items as they wait for some certainty on the future. Our plans to relocate to the A1 at Setloa have now been put on hold as we curtail capital expenditure until the long-term impact of the pandemic is better understood. The 3 brands of MAN, Tata and Honda continue to generate a profit with encouragement and support from the principals. The second part of the trading other business is mechanized farming. You will recall that we rationalized its activities a year ago, and this business now focuses on supporting the stock management and procurement for Botswana Railways. This business is now profitable and generates a respectable profit. I will now turn to our manufacturing business, which is predominantly Foods Botswana in Serowe, which is the milling division, and Foods Botswana Beverages in Gaborone, which is our beverages division. Our manufacturing business has always been a key focus area for us. This year, the business contributed to 4% of turnover and 7% of total profit before tax. A 69% profit growth, we are very pleased with the results of this division, despite significant delays in tender awards. At the milling division, we manufactured for government for only 2 out of the 12 months. Supply towards the previous tender ended in July 2019, and it was only in April 2020 that the next tender decision was made. In this new 24-month tender, Foods Botswana was awarded approximately a third of both the Tsabana and the Malutu tenders. We are on track to continue to deliver on time and to the order quantities. We welcome any further quantities should the government require us to fulfill the needs of other depots. We have a strong track record for delivery of a quality product and have procured all the required grain and other raw materials to be able to deliver on the entire country's requirements should this be requested from us. During the year, in support of the local Botswana farmers, 57 million pula worth of grain was secured from Botswana Agricultural Marketing Board and a further 17 million of grain was sourced directly from farmers. This was especially appreciated during the pandemic period. Going forward, we will continue to focus on branded products so as to rely less on tender activity. We launched some new products in the market. Cocoa feeds is an example. This chicken feed is already proving to be popular in the market. We also launched the Sechaba maize meal to replace the Matla brand. Sechaba has proven to be a stronger and more welcomed brand, and as a result, we felt this product would benefit from this rebranding. We look to extend the packing of a wider range of pulses in the coming year. We also intend to expand into wheat milling to complement our sorghum and maize milling in Serowe. Our beverages division is heavily dependent on the manufacture and supply to government for the children's feeding scheme. In March 2019, we were pleased to be awarded the 24-month contract. In the early part of the year, there were restrictions in place on the importation of raw materials, particularly milk, following the breakout of the foot and mouth disease in South Africa. This slowed down our production, but now that these restrictions have been removed, we have managed to catch up on the backlog. This division performed exceptionally well this year. As with milling, our focus is on growing the branded products so as to reduce dependence on tenders. We look to grow the market share on Delta Fresh brand, which is now found in almost all retailers and wholesalers and is proving to be a very popular local brand. Our expansion into fruit juice manufacturing and bottling of water will require us to develop a warehouse to accommodate additional plant and equipment and also storage. This is expected to take place once we have lifted our restrictions on capital expenditure. I would now like to hand over to our Group Finance Director, Mr. Mohammed Osman, who will take you through the rest of the presentation.
Our South African investment. As previously reported, in July 2017, we entered into the South African market with our preference share arrangement for 250 million rands. Under this arrangement, we have a 5-year term during which we earn a coupon of 50 million a year, with the idea of doubling our money in 5 years. This investment also has the option to convert our investment into a 30% equity stake at the end of the 5-year period. We entered this arrangement in order to mitigate against the risk of entering an economy which we were unfamiliar with. The reported results includes 38 million pulas worth of dividend income from this preference share arrangement. You will note that in the prior year, there was an additional 11 million which related to the fair value gain on this instrument. The current year valuation is in line with last year, and therefore there has been no additional fair value gain reported this year. Our partners in South Africa are a set of consortium members in the FMCG sector. We have a business consisting of 15 stores, and these are located across South Africa. We are very pleased to have received our third coupon payment in July this year. In about 6 months' time, we need to make a decision on whether we want to exercise our option of converting into an equity stake or to exit the preference share arrangement. The economy in South Africa has struggled over the last 6 months, but we're pleased to say that our businesses there are operating broadly in line with budget. The next 6 to 12 months will be telling time for South Africa. If we as a business feel the exposure to that economy is not within our appetite, we will not convert into an equity stake. As you can see from the map, we have very well placed in terms of our footprint in South Africa. And the best thing about this investment is that if we feel that the South African environment is one that we want to exit, we are able to do that. This investment has therefore been one of Sefalana's best investment in all its history, generating a yield of 20% per annum. Our property portfolio performed well during the year and contributed to 1% of turnover and 15% to profit before tax. The KSI properties are fully let and all our other properties have leases of between 5 to 7 years, yielding very positive returns. Our site development at Setloa is now complete with our Sefalana Shopper, Sefalana Quick, Ital Tiles, and a remaining space for our motor dealership. During the year, we revalued our properties, and in line with expectations, the gains and losses have been very modest. We continually look for sites which are suitable for new store openings or where we've got some upside potential. In Namibia, we established our first property in Windhoek last year, where we established our main cash and carry. We had plans to further develop this site, but given the difficult trading conditions in Namibia, we decided to put that on hold. We made use of our existing premises and still retain the land that we had earmarked for this purpose. As mentioned previously, one of our two new store openings was in Keetmanshoop. There, we spent 27 million Namibian dollars at the site. We don't have any current capex anticipated in the coming year in respect of properties. We still have our one property in Zambia, in Lusaka. Following the significant increase in office and warehouse space in Zambia, Lusaka in particular, since 2017, two of our largest tenants moved out. Since then, we've been looking for replacement tenants. We've now achieved a 70% occupancy rate, but the rental yields are much lower than they were in the past. We continue to look for replacement tenants, but in the meantime, this segment's performance is below expectation. We were, however, impacted this year by the significant change in the foreign exchange rates between the US dollar, the kwacha, and the pula, and as a result, saw a small revaluation surplus in respect of this property. Overall, therefore, across Botswana, Namibia, Lesotho, and Zambia, fair value gains this year have been modest and in line with expectation. At Sefalana, we believe in partnering with our communities to improve the lives of the people around us. We believe that through conducting our business responsibly and ethically, we can better underpin the needs of our society and develop programs to assist those that are less fortunate. This year, the group mainly focused on its CSR activities towards improving the livelihoods of a number of communities across the country through the provision of groceries and healthcare products to vulnerable children and families so as to promote healthier living. We have also continued to focus on the education sector with a view of providing a better learning environment for the children of Botswana who are our future. This included the upgrading of a number of learning institutions and facilities. We also contributed towards the government's COVID-19 relief program this year. So how have we created value for our shareholders? Total earnings per share for this year amounted to 78.9 tebe. We have declared a final dividend of 27.5 tebe, and this will be paid in August. Earlier in the year, we paid an interim dividend of 10 tebe, giving a total of 37.5 tebe for the year. We felt it important to pay a good level of dividend despite the pandemic, bearing in mind the difficulties that some of our shareholders might be experiencing in terms of cash flow. We're very proud to have been able to do this year. Over the last 6 years, we have distributed 47% of our earnings in the form of dividend. The bar graph represents earnings against dividends. The yellow bar represents total earnings, and the blue bar represents dividends paid. As you can see, over the last 6 years, we have paid out, on average, 47% of earnings in the form of dividends. We hope to continue this level of payout in our dividend policy going forward. There were no changes to the board composition during the year. However, on the 31st of May, Dr. Keith Jeffries resigned from the board. Dr. Jeffries was on our board for 6 years as an independent director and provided invaluable guidance and support. We would like to thank him for all he has done for the Sefalana Group. Dr. Jeffries moves to an exciting role in government with the Ministry of Finance and Economic Development, and we wish him all the best. At Sefalana, you can always count on us to look for new and exciting developments. Over the last 18 months, we've been conscious about our exposure to the region, in particular to the South African rand and the economies in this area. These businesses result in earnings being translated into our functional currency, the pula, and this year we've seen significant foreign exchange volatility. As a result, we embarked on looking further afield for currencies which were stronger and more stable. We're very pleased and excited to have announced that following the year end, on the 7th of May, we entered into an arrangement in Australia for a 40% equity stake in an FMCG business. The business, by the name of Seasons, consists of 7 stores in the Brisbane area. We have partnered with a consortium of members which are similar to those from our South African consortium. This economy is a lot stable, and the currency has seen an appreciation already since our investment. We're very excited about this opportunity. We invested 9.9 million Australian dollars, which is about 70 million pula, and we expect a really good level of return to come in as our first phase of investment. We will continue to evaluate additional stores and targets in the Brisbane area and anticipate over a 10-year period to becoming a very significant force in the Australian economy. At Sefalana, we are proud to have a strong governance structure in place. We pride ourselves on excelling at financial reporting. Over the last 6 years, we have consecutively won prizes at the PricewaterhouseCoopers annual report competition. We hope this year we win again, and we hope you enjoy our annual report. In closing, I'd just like to thank you all for finding the time to watch our presentation and that you've accommodated us in this new format. I'm sure you'll agree that it's a hugely proud moment for us to present these best ever results to you once again. We'd like to thank our shareholders for having faith in us, our suppliers for supporting us, and our customers for making this all possible. Lastly, I'd like to thank our very valuable staff, without whom this would not have been achievable. Our Q&A session will follow shortly. We look forward to seeing you on there to answer any questions that you might still have. Thank you.